All right, all right. We are good to go. All right, hello everyone, and welcome back to another episode of the Hizzy Hustle. I am your host, T. Hizzy, or Tyler Heisman, licensed realtor here in the Okanagan with Oakland Realty and the Heisman Group. Um, Today, I want to take a little bit more of a dive into some best practices and this area of difficulty where we're talking about the people who were affected by COVID and the inflation and the increase in prices and all that type of stuff, but then didn't have any assets or anything that were able to carry over and help them with the inflationary rise of the cost of living or whatever, right? So these are your typical renters, younger people who are now kind of getting to that age, your early 20s, your mid 20s that are hoping to hopefully get into the market soon. These people are particularly in a tough spot nowadays in comparison to most. In 2016, when I bought my first place, I was in my, early 20s or whatever. I had a great job working out of town up north. I was making decent money, in the oil field as an electrician. So there was a lot of ways that you could kind of make that work for you. And the prices weren't ridiculous at that point. So something happened over the last 5 years, obviously, that has completely changed, or the 6 years that have completely changed kind of where this market is and where people are economically, and how much that economic pressure really affects how people are able to spend their money and if they're willing to do so. Because a lot of people, for the longest time, and I'm not too sure how people feel about this type of topic, but unfortunately, we've lived a life that was very, very good up until, well, not this is the wrong way to go about it. It was, you were able to overspend without putting yourself in a situation of detriment, right? Where nowadays, because of the cost of living and because of inflation and how bad it got, and the fact that people aren't making more money to the same extent. Now, if you're one of those people who lives paycheck to paycheck, or if you're in a tough situation where you have to budget strategically, these external factors have a huge, huge role to play in how you go about planning and whether or not you even feel like you're going to be able to navigate this type of a market in these prices, right? Down payments are a perfect example. When you're talking about 5% on a $500,000 house, that's $25,000, right? And that's, for a lot of people, that's a really tough amount of money to just come up with when you're trying to buy your first home. And I'm not talking about an unreasonably priced home. $500,000 is a very cheap home if you're talking about a single detached dwelling in the area that I'm at. Average home prices around here, average single family dwellings are like 730 or 740. I did a video on it last week or whatever. So there's a huge discrepancy between the people who are trying to get into the market versus the people who are already in the market. And I think this is the thing that a lot of people are going to really struggle with, is that unfortunately, based on what has happened in the world, and to nobody's fault, we're just in this position now. Unfortunately, there's going to have to be an unprecedented amount of sacrifice and forethought and suffering in order to put yourself in a position that you can capitalize on these types of market. Because right now, I personally believe in this next year is going to be a wonderful time for those people who feel like they have, or like they were just about to get ready, or they were on the cusp of getting ready for buying before COVID. And then everything happened. And then you obviously know what it would have been like competing in that market. It was just absolutely insane. So I feel like there's going to be a time here shortly where people are going to feel like they're able to breathe. And if you are one of those people who watches your spending, doesn't splurge, and stays very, very you have to have a lot of future sight in what's about to happen, because if you're not prepared, then you'll never be able to catch up. It's a game of you have to be proactive. You can't be reactive in this market anymore unless you're the type of person that has a bunch of assets, right? Like, I'm sure there's a lot of baby boomers that won't have any issue in this moment because they bought their house for $100,000 and it's paid for, and they're able to just cash out and move forward, or pull equity, or this or that. There's options, right? So for those people who are in a position of, renting through COVID, where you're stuck in your spot because they can only raise rent prices so much every year, a lot of those people were stuck either staying in the rental that they're at or being evicted due to sale so that the person could recoup some of their prices, right? Because rent for those people who made it through COVID was the only thing that was decent. Like, there was one place in Vernon that went up for sale. It was just a 3-bedroom little kind of like a heritage home type of, those like little square homes with just like a little residential lot. Not a big place, probably like 1,300 square foot. And they ended up having to sell the place because somebody had been living there for 10 years. And because of the way that the rental laws are, and you can only raise the rent so much per year, they were losing almost $1,000 a month based off of where the market trends went during COVID. So that is how bad it got. So there is a huge discrepancy between these two classes of people. And there's a video that we're going to watch today from Bloomberg that's talking about just the economic pressures weighing on household finances, and how a lot of Canadians nowadays have been leaning on credit cards, lines of credit, and pulling equity on all their assets that they might have had just so that they can make it through. So if there are people who are suffering through the rental stuff, like, to have this pushing them into the position that they're in now, it's really tough one to get out of. So for a lot of people, or for those who are yet to get into the market, if you haven't been already, you need to seriously take a step back, try to look at things objectively. I'm not happy about any of this as much as anybody else is, but if you want to succeed, you're going to have to suffer in the short term. It's just the way it is. It's really unfortunate, but it's not like it's much different than it was in the past, right? Like, unless you have a job that kind of, beats out all the problems or inflation and the rising cost of good or whatever. Like, if you make a good amount of money, this isn't for you. But for those people who are at that point where you're like, you think it's possible, but it's just a little bit out of reach, you got to suffer. You got to look at your finances. You have to go through, you have to budget, you have to be strict. Imagine that you are like, you have to live by ends meet, and that's it. So everything else has to go into the idea that you're going to capitalize on an opportunity when it presents itself. You have to be ready. So, first and foremost, you have to know how much you're approved for. And pre-approvals are one thing, but before you're shopping, you really need to know what you're approved for. You don't want any hiccups on that front, right? So live within your means, live within your budget, play within your budget. And if you don't need to go and do something, if you don't need to go and buy out that meal, if you don't need to do this, like, yeah, unfortunately, there's going to have to be a lot of suffering in order to get ahead. It's just the way it is. Either that, or I hope you win the lottery or something, because, the market from where I'm at, from the start of COVID to the end of COVID, home prices went up 3 times. We're talking 10 plus years worth of inflation that was done in 3 months. That's a really hard thing to get back to. And there's a very good chance that in the process of those 10 years, where you're hoping things will stay steady, something else is going to happen that's going to cause things to change. So when that thing inevitably happens, you want to be in a position to be able to capitalize on not other people's misfortune, but you need to be able to capitalize on an unfortunate situation. You have to think for yourself, and you have to think in the future. It's really, really difficult to do. It's not fun, especially in these types of situations where, like I said, it's to no fault of anybody, right? We're talking about a once in a lifetime global pandemic in which at the start, literally everybody who was a realtor thought that they were never going to sell a house until this was over or whatever. And then look what happened, right? Like, just, it's so hard to plan. And real estate in particular, especially in the areas that we're in, it's like trying to predict the future. It's like trying to win the lottery. It's really, really difficult to put yourself in a winning position if you're reacting. So proactive, most important thing. Wow, that was a 10-minute rant. I wasn't even really planning for it. So that's my spiel for the intro of this video. We'll do what we normally do here, and we'll just quickly take a look. We got in the Okanagan here 29 new listings in the last 24 hours, 20 price decreases, 19 sold. That's a good amount. 13 canceled and 4 expired. So nothing too out of the ordinary, but yeah. Sold to new listings is pretty good. I think we're sitting at roughly 10 months worth of inventory in the whole association. I just looked it up, maybe a little bit less. I think we have just under 7,000 listings currently, and in the last 30 days we sold about 720. So yeah, kind of that 10 months, 9 to 10 months worth of inventory at the moment. So not too bad. Let's take a look here at Bloomberg and some finance kind of experts just talking about just a little bit of a different take on what I was just
Canadians are increasingly relying on credit cards to make ends meet, and the amount of debt piling up among insolvent households spiked by almost 20.
That was the other point I was making. If it's possible, you have to get rid of all liabilities. Debt, credit cards, vehicle payments, any loans, student loans, you name it. If there's a possibility to get rid of that stuff, it's good. Don't put yourself in a financial position where you have no cash just to do that, because I don't think it's going to help that much. But you don't, at this current moment, the way that things are going economic wise, you want assets and no liabilities, and you want no cash. Cash is going to be the least valuable thing as an investment that you can hold. Now, I don't know where people are when it comes to the idea of investing and saving and all that stuff. If you're putting all your savings into a savings account and you're really good at saving your money, that's great. But unfortunately, the Canadian dollar is like one of the least valuable things that you could have when it comes to savings. Because at the current moment, all that money that you're saving is depreciating in value based off of what the government's doing, based off of what Trump decides to say tomorrow. So if you're trying to save cash, that's not necessarily the right move. There's a lot of other things. There's assets. That's why, homes are good to invest in. Real estate ETFs. Look online, go find whatever government person that's making a bunch of money or whatever, and just find out what stocks trades they're doing. There's certain ways to protect your wealth. And I mean, I'm not saying go and try to make money from stocks, but there is very safe assets to buy that will help you keep cash and appreciate instead of depreciate, because a savings account barely gives you any money, right? Like you'll get nothing out of it over the year. So if the dollar keeps devaluing, your money just becomes less and less, or just worth less and less. So
6% last year. Our guest says this latest report, quote, tells a troubling story. We're joined by Doug Hoyes, co-founder of Hoyes, Michaelos and Associates. Thanks very much for coming on the show.
Thanks, Andrew.
We often hear credit card debt called toxic debt because the interest rate is in Tony Soprano country, north of 20%, but people are turning to it.
Yeah, you're exactly. good. Okay, we refinance our house because that's the lowest interest rate. As things get a little bit worse, okay, maybe I have to rely on a bank loan. We kind of move up the risk curve, as it were. Well, what we're seeing now is that people are getting tapped out on their mortgages. Now they're getting tapped out on their unsecured line of credit. What's the next thing you turn to? Well, it's credit cards. And what we saw with our clients, so this is the people who filed a consumer proposal or a bankruptcy with my firm, Hoyes Michaelis, last year, their credit card debt has gone up by a massive amount, like you said, almost 26%. That is a huge indicator of what's to come, and obviously it's a very troubling statistic.
Because people need to be desperate to turn to credit cards?
Because, yes, maybe not desperate, but it is not your first option. If you want to borrow $5,000, you get a bank loan at 10% interest. You're not putting it on a credit card at 20% interest and not paying it. So
problem is it's a lot easier to get a credit card and to increase the limit of that credit card than it is to get a bank loan nowadays.
Look at this as a glimpse of what's to come. A lot of people think, okay, well, you're talking about people who've filed.
And some people are just embarrassed to go to a bank and to apply for loans for no other purpose than to help pay their bills or something like that. So instead of putting that, not that shame, but instead of having that interaction with somebody at a bank, people are just loading their credit cards and hoping something will come.
An insolvency, that's not representative of the Canadian economy. And no, I would agree that that's true. But what it is a glimpse into the future of what's to come. If a certain segment of the population is getting into trouble now, as the economy continues to have problems that you continually report on, then this is probably what we're going to see more of as time goes on.
The overall, in the economy, do you have any kind of a handle? Are consumer insolvencies or proposals or bankruptcies increasing, Doug?
Yes, they absolutely are. They were up, depending on where you look in Canada or Ontario, Ontario was up 18% last year. Canada was up about 11%. Now, that's off a relatively low base because insolvencies plummeted during the years, 2020, 2021. Nobody was, courts were closed. People weren't getting garnished. People didn't need creditor protection. But that number has been increasing steadily. It was a big increase last year, and we expect that pace of increase will be even greater in 2025.
Among people who are filing or who are insolvent, they've seen a huge drop in their homeowner equity. Why would that be? I mean, house prices haven't collapsed. I mean, I know they're down from their highs.
And that's the key. They're down from their highs. So if you bought your house 20 years ago and you don't have a mortgage, you're not coming in to see me, you got tons of equity, everything's fine. But if you bought your house at the peak in, let's say, 2022, you had a 5% down payment, got a high ratio mortgage, and you perhaps got a variable rate mortgage, or you had a mortgage locked in at a very low rate. Now we're starting to see those mortgages come up for renewal, and there's a whole lot of them that come up for renewal in 2025 and 26. The people who've already had it come up for renewal now have much higher interest rates that they're paying. And those are the people who are going, maybe what I need to do is sell my house to get out. Well, if your house value is down 10% and you had a 5% down payment, you're underwater. And that's something, we're not seeing it with a massive number of people, but we didn't see any of that in 2022. There was nobody who was underwater on their mortgage.
Remember now that there is legislation in place that I believe you have to stay with your lender. So if you make it to the end of your 5-year term and it's time to renew, your lender can't double hit you on, I believe they have to renew you just at whatever rate that's offered. And you can't go and shop, because if you go and shop, then you're going to have to re-qualify and do the stress test, which most likely means you'll qualify for a lesser amount. Because some of these people, remember, they're coming up about 3 times what their interest payment was for the last 5 years, because they walked in at 1.5 or whatever, right? Just unheard of rates. So, it was, if they were advised, which it was a tough one, because the Bank of Canada and the Prime Minister said that the cost of borrowing is going to be low and it's going to stay low. And people thought that was true, and it was not true. So it's going to be a really tough time for some people. And there is going to be a lot of people who are, like you said, are going to be underwater.
Now we're starting to see it. And that, again, is something that is going to continue to get worse as time goes on.
And remember, this is just going to start happening now, this year. All these people were up in 2020.
What is the cause of this increased stress on households? I mean, unemployment hasn't gone up that much. I know it is up.
That's part of it. You're right. But you're right. That's not a massive stress. I think one of the biggest ones is inflation. And again, people are going to say, well, inflation, you just reported it's down to lower levels. Yeah, but it was quite high. There was a period in 2022, 2023, we had like 6 months in a row where, food inflation was more than 10%. And so even though the inflation rate has come down, the costs have not come down. Inflation just means the costs are not going up as fast. So we're...
Bingo. People need to hear this. Inflation being at the 2% mark only means that they feel that the economy has stabilized, or the price of, like, you know what I mean? The price of goods rising has stabilized. Like, the 2% inflation mark is not anything other than things are only going to go up 2% per year, which is a very reasonable expectation. It's the same with rents. It's the same with what we expect our home prices to do. 2% inflation is a nice curve. It's what we saw for years and years and years. So people think that when inflation goes down, the cost of living is going to go down, or there's a chance that it could, but that's not going to happen. The cost of living is what it is, and it's here to stay. Like, there needs to be, if things go down in price, there's much, much, much more issue that we're going to be facing. Like, our dollar is going to be worth nothing, right? Like, we'll be in a recession. Like, we don't want to see the cost of goods to go down. What we want to see is the quality of life increase, wages increase, jobs increase, taxes get cut. Those are the ways that people are going to get relief.
We're still paying those high prices. And of course, now the threat of tariffs and everything else is spooking people as well. The people we're seeing did not see their income go up as much as costs have gone up. They get squeezed. What do you do to bridge the gap? You turn to credit cards. That's what we're seeing.
Is there any sign of an improvement, or do you think we're on a downward trend here?
Well, I hate to say it, but I think we're on a downward trend. And again, if you own assets, if you own a house, if you got money in the stock market, your crypto's doing fine, everything's great. But it is the segment of the population that does not own assets who did not benefit from inflation. Their house price didn't go up because they're a renter. Those are the people who are getting squeezed the most. Mm-hmm. Their costs have gone up faster than their income. And I don't see that changing. I don't see a big spike in incomes. I don't see any kind of drop in prices coming up. And as mortgages, other debts come up for renewal at potentially higher interest rates, that puts yet another added stress on people. So if the unemployment rate does tick upwards, if tariffs do come in, then yes, I see a lot of trouble on the horizons for people who are carrying debt and don't have significant assets to back it up.
We were joined by Doug Hoyes. Thank you very much, Doug. And he's co-founder of Hoyes, Michaelos and Associates.
Well, you heard it there, people. So, like I said, this is going to be a time that could potentially make or break some people. You're going to suffer one way or another. So choose to suffer now, and hopefully you'll be able to get yourself in a position that might be a little bit better. And if you're one of those people that was able to buy a house before COVID, if you got assets, if you were good with budgeting and all that type of stuff, then keep doing what you're doing. You're on the right path. And hopefully we're going to get through this together. But, it's going to be really important now more than ever to stay on top of your finances, get a good budget, live within your means, and to be honest, expect the worst. Just expect the worst. And if you're planned for the worst, then when the opportunity presents itself, you might be able to capitalize on some stuff. So we're all in this together. I'm just trying to help you guys navigate. Hopefully you guys like the episode today. Hopefully it gets some views. Yeah, I still need to come up with some type of one of those like little drop pages that shows like, oh, hey, here's my Instagram, here's TikTok. I do make TikToks. They're actually doing all right. Managed to get like almost 800 followers in a week, so that was pretty good. So follow me at Hizzy Hustle on TikTok and Instagram. I'm at Tyler.Heisman. Yeah, that's about it for today. Thanks for tuning in. I appreciate it. And